Assalamualaikum and a very good day to everyone. I'm Iman Nurhafiy bin Azizi from KBA 2722B, and today I will present my individual assignment for FIN546 on the topic of Murabahah in Islamic finance. In this presentation, I will explain what Murabahah is, how the contract works, some current Sharia, market practice and digital finance issues, as well as recommendation to improve its implementations. Let's begin. Murabahah is one of the most widely used contracts in Islamic finance today. It is essentially a sale contract where the bank purchases an item that the customer needs and then sells it to the customer at an agreed profit. Unlike conventional loans, Murabahah avoids riba or interest, which is strictly prohibited in Islam. The bank must actually own the asset before selling it, and this ownership is what makes it Sharia compliant. Murabahah is popular because it is simple and straightforward and gives Islamic banks a fixed return. However, some scholars criticize the Islamic finance industry for overusing Murabahah and neglecting other contracts like Mudarabah and Musyarakah, which are more focused on risk sharing and fairness. In a Murabahah contract, the process begins when customer approaches the bank and requests to purchase a particular asset. The bank then buys and owns the asset before selling it to the customer at a profit. It is important to note that the bank must genuinely take ownership and accept some risk before selling the item. This is what makes Murabahah different from a loan. Sometimes, to make the process faster, the bank allows the customer to act as its agent to purchase the assets on the bank's behalf. The focus in this discussion is on Murabahah used for real goods like cars, houses, and machinery, not on commodity Murabahah, which is sometimes used just to obtain cash. One major issue with Murabahah today is Sharia compliant. Many Islamic banks rely too much on Murabahah and neglect other contracts that involve profit and loss sharing like Mudarabah and Musyarakah. This overdependence reduces the diversity of Islamic financial products and can move Islamic banks closer to conventional practice. Another issue is that Islamic banks often use interest-based benchmark like LIBOR or Calibor to set their profit rate. Even though the contract avoids interest, using this benchmark can make Murabahah look too similar to a regular loan. There is also debate about wa'ad, or the customer's promise to buy. In some countries, this promise is legally binding, but in others, it just seen as a moral commitment. This inconsistency can create risk for banks if the customer backs out. In the market, some Islamic banks do not fully follow the proper Murabahah steps. Instead of actually buying the item, they simply give money to the customer and call it Murabahah. This invalidates the contract because the bank must own the item to comply with Sharia. Another issue is how some banks handle late payments. Adding extra fees or increasing the price due to delays is similar to charging interest, which is strictly forbidden. Any late penalty should be donated to charity, not taken as a profit. Additionally, Islamic banks in different countries follow different accounting and Sharia standards, which leads to inconsistency and confusion, especially in international transactions. In the digital era, many Murabahah transactions are now complete online. This is convenient, but it creates new challenges. Sometimes, the bank's ownership step is not clearly shown in the system. Also, many digital pricing tools are still based on interest models. Another concern is whether a customer's digital promise, such as clicking "I agree," is considered valid under Islamic law. Scholars are still debating this. Many Islamic banks use the International Financial Reporting Standards or IFRS, which are based on conventional finance principles. IFRS applies the time value of money, which is linked to riba, and often records Murabahah as if it were a loan instead of a sale. This confuses investors and customers who may think Islamic banks are just labeling traditional loans. On the other hand, AAOIFI standards provide Sharia-compliant accounting rules that better reflect the true nature of Murabahah as a sale contract. Unfortunately, AAOIFI is not used globally, and each country often follows its own system. This lack of standardizations makes it hard for international investors to compare Islamic bank from different countries, reducing trust and transparency. To improve the Murabahah process, I recommend that Islamic banks, scholars and regulators work together. First, adapt AAOIFI accounting standards more widely. These standards will help ensure Murabahah is recorded correctly and remain compliant Sharia. Second, banks should stop using interest-based benchmarks like LIBOR and instead develop Islamic pricing models based on real market data or commodity prices. Third, there is a need for international cooperation to create standardized Sharia rules that can be accepted across borders. Finally, we need to update Sharia guidelines for digital banking, fintech apps, and international transactions. As digital finance grows, clear Islamic standards are essential to avoid mistakes and protect customer trust. In conclusion, Murabahah is a very valuable tool in Islamic banking. It helps people avoid interest-based loan and gives banks a Sharia-compliant way to make profits. However, current practices show several issues like skipping ownership steps, using interest-based benchmark, and inconsistent accounting across countries. Islamic bank must focus on Sharia compliance, ethics, and transparency at every step of the contract, from buying the assets to calculating profit. Stronger standards and better practices will rebuild trust in Islamic finance, not only among Muslims but also in the global financial market. Thank you for your attention.